So what I like to do, and it's dependent upon my trade size, because my trade sizes vary, and they vary, and I do this intuitively, you know. So I have three main trade sizes, fully leveraged, you know, and then I have one on an extra one on either end. So let's just say, like, I have, you know, a $5,000. Okay, that's my extreme low, and then I have a 7,500, a 10,000, and $15,000. Now those three are my median, right? And then I have a $20,000 trade size. Okay. Now I will pick one of those, and I typically always use 50x. All right. But I will pick one of those depending upon my intuitive risk, right? Like, how risky do I think this move is? How likely is it to, find support or hit resistance or whatnot, right? And that's not for everybody. It works well for me to do that intuitively. I've tried to adjust that in a mechanical way, but I'm much better at just intuitively seeing things, I guess, in that way. So I'll adjust that. Okay. Now, if I see an area on the charts and I see two levels, and those two levels are so far apart that I'm not willing to assume the amount of risk, because I have a typical dollar amount of risk that I like to take, right? It's not very strict, but it is, a guideline. Okay. If those two levels are too far apart, what I'll do is I'll split that trade in half, right? And I'll put half of it on the lower one and then half of it on the higher one, and then adjust my stops accordingly on each of those. And I can even double that up. I can split those up into four. Now, does that mean if one of them gets hit and the others don't, I make less money? Of course, but I also lose less money if the first three don't work out. You see what I'm saying? So there's a lot of different strategies.
Manage the trade post? So I mean post entry. Do you trail based off like the
no? I never do trailing.
So when do you take your partials?
Okay. All right. So this is two ways that, well, not two ways, but two parts of the way that I do it. So let me get my brush here. So let's say that I enter here. Okay. And then the move comes up and it comes down, and then my stop is here. Okay. I should be using like actual lines, but you get my point. So
this works.
Now, if my risk, let's just say arbitrary number, let's say my risk is $30. Okay. This is one way, as soon as I make $30, then once I, surpass that, so I can close part of my trade out to remove risk. So if it does come down and do this, like it comes down and then it comes up and it stops me out, but then it continues to go down, if I can remove my risk from that trade, so if I do get stopped out, I don't lose any money. My fees are covered and my stop is covered. That is one way that I will do things, right? The other way, and I don't like adjusting my stop loss. And I'm going to show you a perfect example as to why right here. And this relates to the trade that I just took. So let me go to the 15-minute, reset the chart. And then I was like, yeah, okay. The red line is my entry, right? That's where I got in on my short there. Now, I adjusted my stop, but the only reason I adjusted it was because I took profits. I think I took some here, and then I took another. I took 25% here, and then I took half of what was left here, and then I took half of what was left here. All right, and then I left the remainder open. And I told someone else the other day that I was like, I think it's going up, and then ultimately going to pull back again. But I'm going to leave what I have open because a small amount, I've already taken profits multiple times. And then I adjusted my stop, because my stop was probably like up here or here. I can't recall exactly. And I adjusted it, just a little lower, like down here, and then it came up and it stopped me out, but I still made, a percentage amount on top of the take profit points, right? But if this hypothetically, if I hadn't have adjusted my stop, I'd still be in that short. You see what I'm saying? And that's why I really advise against adjusting stops, because they expect you to do it.
Yeah. So people have different ways. I mean, some other people prefer if they entered, let's say your stop was right here. I'm using your screen anyway. Let's say your stop was right here and they entered on this red line. What they do to secure their profits is once they see it create a range like this, they move the stop here. And when it creates, for example, it didn't create anything until here, they move the stop right here. When it breaks structure, right, they move it right here. When it maybe does this again, and then they move it right here, and then they take their profit. Some people do that. Some people do this part just so that they can secure their the money that was risked. Some people do that just so that they can secure. So even if it comes and it pulls back, they make a profit, right? If it comes and back and it breaks up now. So for example, for you, if it comes and it breaks back at this point, maybe you weren't able, maybe you take your profits when it gets to maybe let's say you put in $30. When it gets to, let's say you take your $30 when it gets to like 120, right? So you take off like 20% off. Right, that should be, or is it 40%? Whatever it is, but let's say you wait for 1 to 4 hour and then you take your profit. Sometimes you don't get the 1 to 4 hour, you get maybe a 1 to 3 hour, and then it returns and breaks out. Right. So these guys use this model to ensure that if that happens, they make maybe a 1.5. Now, I understand the disadvantages of it because this can also just come back and do this and then break down, and then you make money. They are out of the trade. So pros and cons, but that's kind of like the reason why they use it, right? That's the reason why they use that model. If they're not the kind of people that like to have a lot of losses. And they take maybe, for example, if you're someone that takes a lot of trades in a day, then this system might be better because you don't really lose money as much. It's kind of difficult if you're always waiting for 1 to 4 and you have like 3 trades who went 1 to 3 and you came out losing the trade at the end of the day, right? Because you wait for 1 to 4 before you start to secure partials, right? This way, you may miss moves like this, but you won't feel sad. Do you get it? Because you probably maybe let's say you're betting 500, you probably make 1,000, and you'd be like, well, I made 1,000, okay, but yeah, I wish I could make 8,000, So pros and cons, as you said, it depends on the personality. Depends on the personality.
Where you came right back to like what I was saying. That's that's why I love our conversations, because we always we meet right back in the middle. This is where the whole personality and the type of trader, the type of trade that you want or expect come into play. That's why those things are so important and should never be overlooked, because how many times have you heard people saying, oh, I had this entry, it was perfect, but then it came up and it stopped me out, and then it went the same way that I was going. But if they had closed the trade or taken profits at those key points, you know what I mean? Like they would have been golden. And it's because
I think if you're the kind of person who cannot really handle a lot of losses, like you don't like to see fill and see a huge win, then you should probably just stick to the trading one because you would obviously see less losses. But you miss a lot of long moves too. So
But
pros
that's
and
where
cons.
pride and ego come into